When markets rally, the underlying assumption is that we're doing something that they're supposed to do, but when markets sink, the questions typically have a what's wrong tone to them. My name is Jill Malandrino, global markets reporter at Nasdaq. Joining me is Steve Sosnick, chief strategist at Interactive Brokers, to discuss just that. Steve, it's great to see you as always. Welcome back to Trade Talks, and you are one of my favorite people to discuss market psychology with because you've seen a lot of it. Tell us more about this add-on here.
That was the nicest way to be called old, Jill. Thank you very much. But what went on for the last 9 weeks prior to this week was we had a rip-roaring rally, and it started out as an oversold bounce, which was good, typical, and some relief rally from the November Fed meeting, and then off we went. And it was turbocharged by the December meeting, and you and I actually spoke on the day of that meeting as well, and just watching the market zoom higher. But during those times, I never really got a lot of questions. Why are we going up? This week, I've gotten several questions. Why are we going down? And to me, that tells you a very different change in how people think. Markets are supposed to go up. Over time, equities do go up. And quite frankly, we're invested in markets because we hope they'll go up. So when they go up, they're doing what they should be doing. When they go down, the perception is that they're doing something unnatural. Again, it's not unnatural for markets to go down. They do go down. They can go down for short periods of time. They can go down for long periods of time. I'll argue a lot of those instances are somewhat healthy. I would say after 9 straight up weeks, it's not unhealthy to get a down week afterwards. It's telling you that people are reining in some expectations and maybe getting a bit more rational. But that's definitely the point of view. We're invested. We're invested in stocks because we want them to go up. We're invested in stocks because we expect them to go up. A little bit different in bond world. Bond investors are much more concerned with, am I going to get paid back, and what's going to prevent me from getting paid back in full? Stocks are all about, what can I make? And sometimes we lose sight of that because we forget that there's a risk involved, that they don't always go up, and sometimes can go down in nasty ways. This week is far from a nasty way when you think about the perspective of what we've been through.
But didn't it almost feel like a self-fulfilled prophecy for the action that we saw this week? No one was really selling it to the end of the year. Why would you? You didn't have any, if you didn't have any losses to take, right? So why wouldn't you wait until the first week of the year and think about rotating into some of the names that have, a more attractive valuation than, what was the S&P up 26% in 2023? You're going to have to rotate into other names at some point.
Well, an interesting thing to keep in mind here is, over the 2-year period, from the start of January 22 through the start of January 24, or end of 21 to end of 23, S&P was dead flat, actually down very, very slightly. Over that same time period, Nasdaq 100, which had a phenomenal year in 2023, was up 1.5%. So essentially, we spent the year of 2023 getting back what we'd lost in 2022. And it's a little weird mathematical thing. If you go down by a quarter, you have to go up by a third to get back. It's this weird reciprocal nature. And so that's kind of what happened. But a lot of it was, I called it weaponized FOMO. If you're an institutional investor, you have to be invested if all your peers are. You don't want to miss your benchmark. You don't want to be in that bottom quartile or whatever it is. Nobody wants to lose their job. Nobody, anybody who's doing this wants to get paid. And so there's huge career risk if you're underperforming. And so we saw massive flows into basically any asset class. And this doesn't matter if you're a bond portfolio manager, a currency manager, or a stock manager. You had to be in it. You had to be playing these huge trends, and the trends became self-fulfilling. It's not, to me, a surprise that the first down day in this little recent mini stretch of down days was the last trading day of the year, because with stocks settling T+2, it didn't matter if you put stocks on the last trading day of the year. So I think that calendar factor is behind us. And as you said, you can start to think again now about, how am I going to rotate? Where am I overexposed? And we saw some measures of people that people were that institutional active managers were overinvested, over 100% invested, according to the NAAIM survey in the last reading of the year. But as of yesterday, they seem to be about 70%. So people have taken a few chips off the table, and understandably so. It's been a great run.
Well, Steve, 4 trading days is not a trend make, right, for the remainder of the year. And there are still a lot of outlying issues that have not been resolved yet, right? Everything feels like it's very macro predicated. What's the Fed going to do? Will they get the soft landing? And how many interest rates and when are going to hit the tape?
Yeah, and that was one of the that was a big contradiction that sort of got papered over during the big run we had because when everything's moving in the right direction, you can have stocks and bonds rallying and short-term fixed income as well. But as you start to unpack it, there are some narratives that don't necessarily jibe. To me, the most important one is the fixed income futures, the Fed funds futures, the SOFR futures are predicting about 6 rate cuts in 2024. Now, we were predicting 3 to 4 rate cuts prior to the December Fed meeting. And then when the Fed said, we are likely to cut 3 times in 2024, the markets immediately said, okay, we see your 3 and we'll raise you 6. We'll raise you 2.6. But think about what is entailed in that. That doesn't occur if you get a soft landing. The basic premise for stocks right now is that we'll get a soft landing, that we'll be able to get some decent earnings growth, call it high single digits, low double digits. That doesn't happen if you have the type of recession that requires 6 rate cuts. So the market has to figure this out. It has to figure out, first of all, what it wants. Do you want a massive rate cutting cycle and massive monetary easing, or do you want a solid economy? I would tend to think the solid economy is more important. But even there, that means we have to work through some stuff because, while we all want the earnings growth, it probably means that that at least the 10-year yields and some others around that part of the curve are a little too low under that scenario. It means we have to price out a rate cut or two, probably means about 25, 50 basis points in yields backing up. So these stocks will have to work through that because the lower bond yields were a massive tailwind in those last 2 weeks. This, as you say, 4 days does not a trend make. It doesn't mean a year. It doesn't really presage the whole year, even though some technical indicators will tell you that kind of does. But we do have some stuff we need to work through now that cooler heads prevail.
Right. And of course, Steve, the risk is if they were to do 6, 7, 8 rate cuts or more than one rate cut at a meeting, let's say, for example, inflation does tick up or there is some sort of shock to the economy, they're going to run out of tools in the toolbox. And you certainly don't want that to happen. I think the Fed has been pretty clear in telegraphing that they don't want to move so quick on the downside like it was on the upside. You don't want to run out of ammunition here.
Yeah, now we are a ways away from running out of ammunition with rates above 5%. But your point is really well taken. They don't want to restoke inflationary fears, and I think the problem is none of us were active in the markets the last time this happened. You have to be kind of an old timer to have been doing this in the late 70s, early 80s. And so the problem is, if you look at history, what the Fed did then was they were a little too quick to cut at the first sign of economic weakness, even though inflation wasn't put back in the bottle. So I think now we do have inflation closer to the Fed's target, but we're not there yet. And I think they're going to be reticent to be too aggressive at cutting if we're close, but not quite there, unless the economic circumstances dictate it. So if you're in the camp of 6 rate cuts, you might want to be careful what you wish for.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.